Okay, and welcome back, students who are taking financial accounting. So in this series of videos, we are working on the assigned homework problems for Chapter 1, the problems that are part of Group B. And so that starts with problem 36B. Now, this, as you can see, it says this problem is going to take anywhere from like 20 to 25 minutes. I'm going to try to just make one video. And if you look at the solutions, I mean, after you've done the problem, I'm going to kind of work through it the same way. However, I'm also going to give my slight take. I don't like working with the accounting equation across the page like they have in the solutions. I prefer to just treat things like journal entries and then posting them to the general ledger accounts and calculating the balances. But we'll see you'll see what I mean as we get through the problem here. So again, it's, even though you see this exercise, work through it, then look at the solution. If you don't get the solution, try to figure out what the solution is doing. If you still don't get it, and obviously now you're watching this video, realize that I can work, it's about, concepts are the same, that can be presented in different manners, okay? But I'm going to present it with what's a little bit more intuitive and makes a little bit more sense, at least to me anyway, and then hopefully it'll be to you, okay? So it says here, transaction analysis and the calculation of net income. So David Shore worked as an accountant. After 5 years, graduated from college. The name of the new he opened his own accounting practice. He operates as a corporation. The name of the business is Shore and Associates. He experienced the following events in the first month of operations. It's the first month of operations. Some of the events were personal and did not affect the accounting practice. Okay, when you have a corporation, it is important to keep your business transactions separate from your personal transactions. Okay, if you don't, this is what's called piercing the corporate veil. Meaning, as just a quick example, when you create a corporation, you're actually and you're incorporating, you are actually creating a separate entity. Okay, you are creating entity. Can't spell. You're creating something out of nothing. Okay. By creating the corporation and you're creating this separate entity, you can work in that entity, but everything that happens, from an owner's perspective, a shareholder perspective, if someone's going to sue, like let's say, for example, you make, I don't know, baby cribs, okay, and there's a defect, and say a baby gets injured, and the parents decide to sue because of the defect in the baby being hurt. Well, they're going to sue the corporation, right? And you might have your own personal assets, okay, like your home, your car, so on and so forth. Well, if you follow the rules of the corporation, okay, and you don't bridge the corporate veil, all right, then when they sue, all they're doing is suing the corporation, okay? They're not going to be able to get your assets, okay? They're going to try to sue you, but they can't sue you because you don't own anything, right? However, if you go and you do, let's say, you're buying, you're buying stuff for your own personal use, that's, and you're taking that money out of the corporation, well, then that's called bridging, piercing the corporate veil, and you're no longer protected. That person who sues you, because you pierce that, and it doesn't have anything to do related with the baby's crib being defective and being sued. I mean, it's your, like you want to, I don't know, you go on a trip and you're going to pay for the trip out of the, a personal trip, and you're paying it out of the corporate funds. That's there. If you don't do it correctly, all right, then you pierce that corporate veil, and when the people sue you, they could come and they could take your home and car and whatever have you, if they win the settlement. Okay, so that just is a quick aside. All right, so let's see here. So it says here, were personal, some were personal and did not affect the accounting practice. Others were business transactions and should be accounted for by the business. So here's the transactions, and then it says requirements. Enter each transaction in the expanded accounting equation as needed and calculate new balances for each transaction. Well, I'm not going to calculate the new balances because why? I need to determine my assets, liabilities, equity, and my profit or loss for June. So if when I have a journal, okay, and in the journal I make my debit and I make my credit, okay, whatever amount that is, okay. Because it's in the journal and I'm entering the transaction, I don't have balances, okay. All it is just, all of my transactions, all right. But now, when I post these journal entries to the general ledger accounts, let's call it, and I'm just going to make this up. I have a cash account, I have a debit and a credit column, and then I can have a balance column. Okay, so let's say this here was a debit to cash, and this here was a credit to cash. Okay, well, when I'm posting these journal entries, remember, all I'm doing is just rearranging the information. Okay, so this debit to cash, whatever amount this is, that would become my new balance. Okay, and then when I have a credit to cash, I would put the amount in the credit column, and then I calculate a new balance. So let's just throw numbers in here. Say this is $100 and this is $30. Okay, so my debit would be 100, which means my balance would be 100, and then my credit would be 30. Now my balance is going to be 70, right? Let me erase all of that and make it nice so I can see it because it's starting to look sloppy. Okay, so let's say this debit was $100 and I had a credit, to something else, so that's $100. And then I have a debit for 30, and I have a credit to my cash for 30. Okay, so when I put in the debit, I'll have a debit, and my new balance, because it was 0 before, and now it's 100, it's a debit of 100. And then when I post the entry for my credit of 30, my new balance is going to be 70. So I'm constantly updating my ledger accounts as I go along. Okay. Now for this exercise, it's telling us to do the transactions based upon the accounting equation and creating the balances. Well, I don't need to create a balance every single time I'm going to make an entry. Okay. I just want to know what the total is, and that's after all of the transactions, so that I can figure out my assets, liabilities, equity, revenue, and expenses. So I'm going to label this assets is equal to liabilities plus equity plus revenue less expenses and less dividends. Okay, the expanded accounting equation. Now, remember, these are categories of accounts, and if we're doing it in this format, then we're going to separate out each and every, ledger account, meaning I would have cash, whatever accounts receivable, whatever accounts payable, common stock, retained earnings, revenue, expenses, dividends. All right, and I would have these general ledger accounts that make up those categories of accounts. All right, so in essence, what they're doing here is by saying use the accounting equation. Remember, when I'm looking at my chart of accounts, right, I have my assets, and I list my ledger accounts underneath assets, and then I have my liabilities, and I have accounts payable, notes payable, so on and so forth. I have equity, right? So I have common stock, retained earnings. So all I'm doing is I'm just changing the format. Instead of listing things straight up and down like you would see on a trial balance or on my chart of accounts, instead I'm putting it across the page, okay? And treating them as ledger accounts. But like I said, what they're doing here is I'm taking a transaction and I'm trying to uh, make a journal entry and post to the ledger accounts, both at the same time when I'm doing it in this fashion. Okay, I prefer to just make the journal entry and then pull up the account, because that's the way it's done on a normal set of books, which you'll see in later chapters. Okay, so I'm just trying to prepare you for what's going to come. Right, so let's take the first transaction, and it says June 3rd, and I'm not going to date these. You would want to put the date down the side, but I obviously have space limitations here. So received 60,000 cash proceeds from refinancing his house. Okay, well, that's a personal transaction. I'm refinancing my house, his house. All right, that is not a business transaction. That's a personal transaction, so that's not on the books. Okay, June 5th, $70,000 common stock in the business was sold. The cash proceeds were deposited in the new bank account titled Shore and Associates. All right, so if you watched previous videos, you know that I asked the question, am I affecting cash? And if the answer is yes, right, is it an increase or a decrease? Well, in this case here, the business is getting $70,000 in cash, right, from David Shore for the purchase of stock. So if he had zero in cash before and it increases to 70,000, well, cash is an asset. Assets increase on the debit side. Okay. So that would be a plus 70,000. So my journal entry would be a debit to cash for 70,000. And I know debits must equal credits, so I have to credit something else for 70,000. And the question is, what am I debiting? Well, he's purchasing stock. Okay. I know stock is not an asset, it's not a liability, it's an equity. So if my stock was zero and now I have $70,000 more in stock, that means I'm going to credit my common stock for 70,000, and my common stock general ledger account increases to 70,000. So I have 70,000 under cash and 70,000 under common stock. And remember, like I said, this is what the journal entry would look like, but we would be posting to the general ledger accounts, each individual account, and I would be posting that $70,000 to the equity account. Why? Because the normal balance of a liability is a credit, and the normal balance of equity is a credit. The normal balance of revenue is a credit. The normal balance of expenses are debits, and the normal balance of dividends are debits. Okay. So I increased my equity on the credit side by 70,000. Right, next transaction. Paid $1,300 cash for office supplies for the new accounting practice. Okay, so I ask myself the question, do I affect cash? And the answer to this is yes. So is my cash increasing or is it decreasing? Well, it's decreasing because I'm paying $1,300 for office supplies. Well, if cash is an asset and I increase the assets on the debit side, that means I have to decrease the asset on the credit side, right? So my journal entry would be a credit to cash for $1,300, right? So that means I'm subtracting $1,300 in cash. And what am I buying? Well, I'm buying office supplies, right? Office supplies are an asset because we own them. Notice it's not office supply expense. If it was an office supply expense, it would be over here underneath expenses, but it's an asset, something we own. So our office supplies just increased by $1,300. It was zero before and it went up to $1,300. So if I have a credit to cash, debits must equal credits, so I have to debit something else. And what is that? Well, office supplies for $1,300. Okay, and notice that all I'm doing is I'm moving, from one asset to the other. Okay, that's why I have a negative 1,300. Okay, next one. Oops. All right, purchased $3,500 of office furniture for the accountant and agreed to pay the vendor within 3 months. Well, if I'm agreeing to pay the vendor, all right, I'm not, I'm asking myself the question, one, am I affecting cash? And the answer to this is no. Why? Because I'm agreeing to pay him in 3 months. I'm not paying him cash right now, right? So if I ask myself, am I affecting cash, and I have a no for an answer, then I ask myself the second question, am I affecting accounts receivable or accounts payable? And the answer to that is yes. Okay. Why? Because I'm buying the office furniture on account, right? I'm going to owe him. So I have a debit and a credit. And remember, accounts receivable is when someone owes us. Accounts payable is what we owe. We have to pay somebody else. So I'm going to credit accounts payable for the $3,500. And if my debits have to equal credits, and I have a credit to accounts payable, that means I debit something else for $3,500. And the question is what? The question is, what are we buying? We're buying office furniture, right? So I'm going to debit office furniture for $3,500. Okay. Well, that's $3,500 for office furniture because it went from zero and it increases to $3,500. And under liabilities, I had zero for accounts payable. Now I have $3,500. It increases to $3,500 for my accounts payable. Okay. I'm going to draw a line down here to try to separate my assets from my liabilities a little bit. Okay. Next transaction. David sold 400 shares of common stock, which he owned for several years, receiving $40,000 in cash. The cash from the sale of stock was deposited into his personal bank account. Well, that has nothing. He's not buying stock. He's not selling 400 shares. It says he's selling 400 shares of Cooper stock, okay, in his personal bank account. This is not the stock for his business. So this transaction is of a personal nature, okay? So it's not entered on the books for the corporation. All right, June 14th, a representative of a large company telephoned David and told him of the company's intention to hire Shore & Associates as its accountants. Okay, well, again, nothing has actually transpired because it's an intention to hire. It's not saying he performed services or anything like that. So there is no transaction that has occurred at that moment in time. And it's just as part of conversations. Now, if he created a contract or something like that, then the transaction would have happened. But right now, it's just talks. It's intentions. It's nothing of any substance. Okay, June 20th, finished accounting work for a client and sent the client a bill for $3,800. The client is expected to pay within 2 weeks. Okay, so he's doing work for a client. Okay, So I have debits and credits. We ask ourselves, one, am I affecting cash? And in this case here, it's no. Why? Because the client isn't paying him cash, right? So I ask, do I affect accounts receivable or accounts payable? And in this case here, yes, I am affecting accounts receivable. Why? Because I'm performing the service, right? And he's expected to pay within 2 weeks. So he's, we're billing him on account. We're extending him credit, right, of $3,800. So we're going to have, accounts receivable as an asset. We treat accounts receivable the same way we treat cash. It's an asset. We increase the asset on the debit side. All right. So accounts receivable for 3,800. Okay. And then we have to find a credit somewhere else. Well, what are we doing? We perform services, so we're billing them for those services. So that's, revenue that we're getting, right? So we're going to affect and this account's name is service revenue. Okay. So we're going to credit our service revenue account. Okay. So my accounts receivable increased by 3,800, and my service revenue account went from 0 and it increased to 3,800. See how I backed into that amount, okay, into that account? All I needed, I didn't have to really, if I understand how to do cash, how to do accounts receivable, and how to do accounts payable, I can always back into the other half of the journal entry. And a lot of students, what they do is they read and they start working on, like finished accounting work for a client, all right, and sent the client a bill for 3,800, and they start working on that aspect of it, and they try to be figuring out, okay, maybe if they figure out it's the revenue account, but they're not able to determine, they make mistakes in determining whether it should be a debit or a credit. Well, if you do cash, just so many transactions doing cash, it becomes second nature, all right? And then, you're doing so many transactions with accounts receivable and accounts payable, they become second nature. And then it's just, so if you determine which is the debit and which is the credit, all it is just looking for the other half, the other general ledger account, and you back into it as to what is right and what is, to make your journal entry correct. Okay. All right. So let's see here. 20, okay, we did 20, 27, paid office rent for 2,400. Okay, so if I'm paying office rent, right, if I'm paying office rent, well, am I affecting cash? The answer is yes. Why? Because cash is going out, and obviously cash is decreasing. And if cash is an asset, and we decrease our assets on the credit side, right? So we have a credit to cash for 2,400. And since debits must equal credits, all I have to do is just look for the account. Okay. Well, if I'm paying office rent, all right, that's not an asset. It's not something we own. It's not a liability. I mean, you could say, well, we owe the office rent. Well, liabilities are more along the lines of what you owe. Okay. As far as notes, credit, things like that from a financial perspective. Rent is a normal daily operation of the business. All right, you incur rent every single day, even though you pay it once a month. So we know it's not equity because it's not an investment in the business, and certainly isn't a sale, so it has to be an expense. And in this case here, it is rent expense. So we have a debit to rent expense for 2,400. Now notice what happened. Okay, our rent expense was 0, all right, and we're increasing it to 2,400. Okay, see how it falls in place? It's a positive number. Our rent expense increased because we're increasing it on the debit side. I backed into it. I didn't have to think about why it's a debit, even though I should understand why it's a debit. Okay, and as far as cash is concerned, well, we have a credit of 2,400, which means, we're decreasing our cash by $2,400. So that's a subtraction there. All right. Okay, and the last entry is paid $700 of dividends to shareholders. Okay. Okay. Instead of, it says paid $700 in dividends. Instead of trying to figure out the dividends, okay, work with the cash. Ask yourself, am I affecting cash? And the answer is yes. What's happening to my cash, right? I'm paying it out because I'm paying out dividends, all right? So cash is an asset, and I decrease my asset on the credit side. So I have a credit to cash for 700, and obviously, debits equal credit, so I have to debit something else. Well, what am I debiting? Well, obviously dividends, because we're paying out dividends, right? For 700. But notice that I didn't have to, think about whether I'm debiting or crediting the dividend, right? It automatically fell into place. The normal balance of a dividend is a debit. In other words, I had 0 before, now I have 700 more, right? See how it went up? And I didn't have to think about why it was a dividend, why it was a debit, even though I should understand that, all right? And so I'm going to credit my cash, subtract the $700 in cash from the cash account, right? So now that we've added all of that in, okay, those are all of our transactions. And, you saw me make the journal entries and think about when I was writing them up in here, that was my posting to the general ledger accounts. All right, because that's what they are. They're the general ledger accounts. Now, the problem said keep a running balance. I didn't keep a running balance. Why? Because now I'm going to total everything up. All right, so for my cash, I have 70,000 less 1,300, less 2,400, less 700. So that gives me a balance of $65,600. For my accounts receivable, I have 3,800. For my office supplies, I have 1,300. And for office furniture, I have 3,500. Okay. When I total all of those together, okay, that gives me $74,200. Okay, so that's the total of my assets. That's number one, right? What we were, that was A here. We're looking for our total assets right here. Okay, then total liabilities, all right? Well, I have 3,500 for the accounts payable, right? So that's my total liabilities, right? Remember, assets is equal to liabilities plus. Now, for common stock, we have 70,000, okay? But note, common stock is part of equity, okay? And we're looking here for our total stockholders' equity and our net income or loss. Well, the only way we can figure out our equity is by figuring out our profit or loss, because we have to take those amounts and move them to our retained earnings account in order to be able to figure out how much our total equity is. Okay, so let me make this in green. And if you watched my other videos, you saw that I think in terms of assets is equal to liabilities plus equity. Okay, but for equity, we have common stock plus retained earnings. And to get retained earnings, what we do is we take from the income statement our revenues less our expenses, which equals our profit or loss, minus our dividends, right? So we have to take this all into consideration in order to know how much profit or loss is actually going over to our revenue account, which makes up part of our equity. So for my revenue account, I have 3,800. And for my expense account, I have 2,400. Okay, so that makes a total of $1,400, right? 3,800 minus $2,400 is $1,400. And then out of that, we have to take out our $700 in dividends. All right. So the profit or loss that we're moving over is $700. So that $700 gets moved over to our retained earnings. Okay. So it is going over here. Okay. And we do that when we get to the end of the accounting period and we close out our revenue, expenses, and our dividend accounts. That gets, again, that amount gets moved over to our retained earnings. So our equity now is $70,700. And of course, when we add up these $74,200, that should equal to $74,200, which it does. And our accounting equation is back in the balance. Okay, so assets is equal to liabilities plus equity. All right, and we know that our net income was for June was $1,400. All right, and that's before we took out our dividends. Okay, so that was that problem. I hope you understood it. If not, watch it again. Watch the video again. Pull out, since you should have looked at the answers, you can, it's in a different format. And again, I didn't include balances and things like that. And it wouldn't have taken me this long to actually do this problem if I were doing it. But this is sort of like how I would have done it on paper in order to arrive at the answers that I arrived at. Okay, so watch the videos again if you don't understand it. And then if you still are missing something, feel free to contact an instructor. Okay.